I'll probably start with a bit of housekeeping just as people are coming online. So the purpose of today is to obviously run through financial things to think about in your finances now, soon, and later. We had a ton of questions submitted in advance of this webinar, which is awesome. So we have categorized them into the kind of now, soon, and later buckets, and we're going to try and talk through those as we go. But we've also allocated a decent amount of time at the end of this webinar for just general Q&A to get through all the mismatch of questions and anything that's submitted in real time. So if you're watching the video now, you can absolutely comment as we go through. We'll get to those questions towards the end. We will kick off. So I'll just bring up a couple of slides. What are we going to talk about today? We're basically talking about managing your money. So something that we often talk about in the team internally at Kernel is this concept of now, soon, and later. But before we get to that, who are we? If you haven't met us before, I'm Kat. I am Head of Marketing and Customer Strategy here, and I am with Dean, our founder and CE. And Dean's going to give us a little bit of a rundown of kind of just 2 minutes on Kernel.
Yeah, so obviously Kernel's been going now for 4 years. We operate a range of funds with our own investing platform, and obviously the big part of our kind of recent expansion has been the launch of the KiwiSaver scheme, where we've got thousands of Kiwis that are able to set and forget their KiwiSaver with our diversified funds, or equally customize their own KiwiSaver. So we've got a lot that's happening with Kernel at the moment. Do keep an eye on us. So if you want to keep up to date with everything that's going on, make sure you're on our mailing list, because then you're going to hear all the latest announcements. There's a lot of news that will be coming out from Kernel over the next sort of 2, 3, 4 months as Kernel continues to grow and new features and products. So make sure you're on the mailing list, keep in touch, and continue to send in the requests and feedback and insights that you have as well, because it does help drive what we're doing every day.
Yeah, awesome, cool. So why are we here today? The general concept of now, soon, and later is just another way to think about your money. So, lots of people have ideas as how they approach their finances. Maybe they're into FIRE, maybe they're into kind of long-term passive investing. We hope you are if you found us here at Kernel. But we like to think about now, soon, and later as a way to break down some of your goals and what you're working towards into more achievable or palatable milestones. So we're going to talk through some of the things that could fit into those categories, and then what types of investment vehicles, strategies, funds, options you would be looking for in each of those groups.
So 3 big buckets, basically, how you would categorize your assets, your wealth, and your strategies, basically.
Exactly. And I think one thing that's really important to keep in mind is it doesn't matter what your age or stage of life is, because everyone's going to have things that they want to do now, soon, and later. So it's really thinking about it in the context of your current situation and I guess your time horizon and what you're working towards. But to dive on into that, what do we mean by now? So everyone has things that they want to work towards in the immediate short term, whether that be a holiday, it's upgrading a car, maybe it's having an emergency fund. All of those kinds of expenses that have a known amount with a pretty known time frame that is relatively short, we would categorize as a now goal. So, Dean, now goals.
Yep.
What do we do with them? It's typically money or a goal that's a very short-term time frame. What should we be thinking about in terms of asset classes or options?
As Kat said, it doesn't matter what age you are. So the whole point of now, soon, later thinking in the bucket is categorizing. So age is irrelevant. It's around the time and use of that money and the investments that you have. And so obviously things that you need to access now, or that you have an immediate purchase plan for, as everybody will understand and appreciate, you just really need to be in that sort of safe haven. You want to ensure that the money's going to be there as and when you need it. So house deposit, new car, wedding, whatever it may be. And so those things typically then lead people to look at cash type investments. So historically, that's been savings accounts, term deposits, but equally people are looking at things like cash funds being really popular. And the reason there is people are trying to go, how do I even boost my cash a bit more? And those short-term savings, and equally thinking about what their tax situation is to have that as efficient as possible.
Yeah. Yeah. So typically, your now goals maybe not be so exciting in terms of, the investment you're looking at or the type of asset class that you're looking at. The goal itself is hopefully exciting because if it's saving for, a wedding or a holiday or a big trip or an OE, whatever that might be, that's the really exciting part. But it's about securing that goal in a way that makes sure that you have that money available when you need it.
I think one of the biggest things with those sort of short-term goals that people have we've seen a little bit of pain from recently is where people have gone into what they thought were relatively safe buckets, such as a conservative fund for KiwiSaver, where people have been planning to buy their first home. And obviously the KiwiSaver is often a large contribution towards that deposit. And they've been in something what they thought was relatively safe, like a conservative fund, and actually found that that's gone down in value. We had conservative funds that had fallen in the market by 10% last year. And again, we come back, like, even if you're thinking about your KiwiSaver as well as your general investments, it really is more cash rather than even sort of short-term bonds, etc., that you often get within conservative funds. So if you're planning to buy your first home or you're planning to access your KiwiSaver as well for that purchase, then you really need to think about more cash-led type investments.
Yeah, awesome. Cool. So I guess a couple of Q&As, Dean, that I'm going to send your way. The first one is you've talked about KiwiSaver, which for some people in a now category feels a little random because unless they're, literally a couple of months away from retirement or a year away from retirement, why should they be thinking about KiwiSaver as something that you should be focusing on now?
So there's only really for KiwiSaver, it's a major asset for many Kiwis now and become probably the second biggest asset you'll ever have in your life outside of potentially a home. And the access to KiwiSaver is 65 or for a first home deposit outside of hardship and others, specific examples. But most people will access their KiwiSaver, or your kids will access KiwiSaver for a first home and then retirement. And so you do need to think about what is the type of fund that you're in for your KiwiSaver in relation to that access point. So first home, as I mentioned, it's a really obvious hard line, and it will be quite critical hard line because you need every dollar of that for that deposit, and you would have built your budgeting and your bank application around that number. And so if you've got KiwiSaver and you're planning to access it very soon for that deposit, you do need to be looking probably more to cash, even that's more defensive than even conservative funds. So cash funds are a great way to be sure of the amount of money or have confidence in the amount of money that you're going to have for that particular moment and event. And we'll talk a little bit more about KiwiSaver with the retirement access later on, but for that quite immediate where the dollar amount is critical, do have a look at some of that.
Yeah, awesome. So a couple of other questions I'm going to send your way. Prioritizing student loans. This is one that I think people often get caught up with in a now goal because, let's say you've finished your university degree, you've got your first job, or you're kind of settled into the start of your professional career, you have some student debt. Is this something that you should be focusing on, generally speaking, under, a short-term goal?
Look, so the nice thing about the way the student loan system works in New Zealand is that it's interest-free and it automatically comes out of your paycheck. So it's kind of a hidden repayment plan for savings that you don't really notice. So with regards to that, I would be thinking about two things: is do you want to start to put more contribution into it or not? And because it's interest free, you really don't want to prioritize that. It's great that it's interest free, so you don't need to top up that up more than what already is coming out of your paycheck. The two things that may trigger you to want to do that is if you're going to move overseas, because if you are planning to move overseas, and unfortunately there are plenty of Kiwis doing that these days, that you will start to incur interest on that. So you will want to have that cleared before you go. The second one is banks and home purchases. So while it is interest free, if you've only got a small amount left on your loan, actually having that paid off may make you more attractive to a bank in terms of the cash flow that you have to fund a mortgage, so or any other debt. So there can be an incentive there if you're planning to buy a home to have that paid down so that the bank looks at your total cash flow without that expense coming up.
Yeah, wonderful. Cool. So on the debt front then, one question that we get a lot, and I think this is the trade-off between some now goals and perhaps, the later goals, is this whole idea of paying off a mortgage versus investing. And we've talked about this before in webinars or on the blog. And I know that, the situation does change based on where interest rates are at, but what's your kind of current take on that?
Look, with the way that where interest rates are at the moment, and mortgages are often around 7%, you need to be getting nearly 10% return on your investments to be the equivalent of paying off or prioritising the mortgage. And so we're seeing a lot of Kiwis now prioritise paying down that mortgage and paying down that debt rather than having disposable income going towards investing. So it is a simple equation in the sense of if you have the debt cost is higher than the expected return on the investment after all the tax, then you should be prioritising the debt. Equally, though, there are some people that like to have a buffer or some assets and investments outside of just the house. So they may have a pool of emergency fund and some general investments because they like something that's accessible as and when they need it as well through the different life stages. So look, reality is we're seeing many people focusing on the debt equation at the moment.
I think good message there is, it's not a set and forget strategy. These are things that can change as, interest rates change, the world, the economy changes, your own situation changes. So it's not something that, once you decide to be focused on debt repayment, you have to do that forever and a day until that debt's gone. You can always review these situations as you go. Awesome. A really good one that came through about, I guess, thinking about the psychology of money piece and a now goal was the question around travel and the trade-off between spending money now on experiences, say going overseas, versus putting that money towards your future and a long-term investment. How do you think about that?
Look, I think we often get caught up in trying to save for tomorrow. And the whole point of saving for tomorrow and investing is ultimately to give us choice and choices in life, and ideally more choices tomorrow, and it gives us peace of mind, right? Having the comfort of knowing that you're financially secure tomorrow is great. But you do need to have the context of it's not one or the other, and it's not about sacrificing everything today just to try and give you more options tomorrow. And I do encourage people, I think it's really important to have that balance as with anything in life. That does mean actually still going on holiday today and spending time with family and doing those sort of things. So I wouldn't look at the numbers of it. I look at it in the context of, look, reality is if you're going to spend a few $1,000s on a trip today, the couple of $1,000s isn't really going to fundamentally change your financial future in 20, 30 years from now. So the value of that time and that experience is probably incredibly worthwhile in the context of the big picture and having that balance between enjoyment today as well as security tomorrow.
Totally agree.
Yeah.
Awesome. Cool. So before we kind of, I guess, move on to soon, some key takeaways for anyone thinking about now goals, things that are on the short-term horizon. We're really talking about things that you want to achieve in the next 3 years, ideally that have a very known kind of deadline and amount associated to that goal. As Dean mentioned, looking at, your more defensive and really conservative options. So your traditional savings accounts, cash funds, term deposits, because you don't want to have that money at risk of any movements because you need it in a very certain time frame. So once we've tackled those, we get to move on to the soon goals. And people kind of think of like, well, what is the difference between now and soon? Because they start to blend a little bit. And for me, the key differentiation between now and soon is less about a number of years involved, i.e., thinking beyond the 3-year mark, and more around the fact that this is something that you want to do in the medium term, but perhaps it has a more flexible date. So it is something that you absolutely you want to do. A good example might be if you have children, you want to send them to a certain school, and therefore that you need a certain amount of money. Or you want to upgrade your home at some point or get into your first home, and your time horizon on that is somewhat flexible, but that it generally is going to be somewhere within 3 to 7 years from now.
Even retirement. Like some people, you don't just get 65 and stop work. Many people will be flexible thinking about what they're part-time or what they want to do with their life. So it's that flexibility is the key piece. These are sort of goals that you have, but the date is not necessarily set. And so you because of that flexibility and because of sort of that medium termness to it, you actually have a lot more options when it comes to how you start thinking about your investments and your money towards those goals.
Yeah, exactly. So we definitely start to think of soon goals in a little bit of a different way to say now, because, with now goals, you very much so have a defined date and amount you need to spend. Soon goals, a really good example that we often see across our customer set is, people that are homeowners and, fall into the trap of being DIYers and want to do renovations. And it's sort of, there's maybe no set time frame. And it's a case of, well, as and when I save up the money, we'll work towards that thing. And that's a really good way. So Dean, with those kind of goals in mind, what should we be looking at? Is it still a place for a cash fund or a savings account, or because there's more time and it's a bit more flexible, do we start to look at something else?
The soon goal, I'm talking about the flexibility piece here, right? And retirement is actually a good example, because there are two ways to look at this, and it depends on whether you've got a large lump sum of assets or whether you've got cash flow that you're putting towards these goals, because I think that changes the equation slightly. When it comes to retirement and people planning for their retirement and going, right, in 5 years, I'm going to be 65 years old, I'm going to access my KiwiSaver, I'm going to stop working. What you tend to see there is people go, oh, that means that because the access to KiwiSaver and those investments is becoming soon, that they tend to want to put it all into, say, a conservative fund. The problem with that is actually you're not going to spend all that money on day one either, and that you want to have some of it invested for a reasonable period of time. So you can look at things like balanced and more growth type investments for these goals, particularly equally if you've got cash flow. So say you've got a soon goal and you want $50,000 for a planned house upgrade in 5 to 7 years. You don't have an exact date. If you're putting in regularly and your base is low that you've started from on that investment journey, I actually think you can look at more aggressive type, high growth type investments, because while they're going to be up and down, you're contributing into that. And so the fact that you're contributing into it and it's not dominated by a large existing piece of investment, then you can be a bit more aggressive, I think, when it comes to the types of investments you're looking at. So more shares and index funds type options.
Yep, excellent. So I guess on the shares index funds option, for anything generally speaking that is a longer term goal, so thinking about those things that do have that 5+ year time frame, how do we make sure that we are reasonably protected from risk, or what's kind of one of the easier ways? We obviously are big passive fund index fund advocates, but could you talk a little bit about that versus, say, putting it all onto one or two types of shares?
I think the big difference here, obviously, particularly with these sort of soon goals, and there's a medium-term access to them. So you don't have 20 years necessarily to ride the ups and downs. But as with any good investing, placing all your money on one single investment is not necessarily a good option in terms of a single company share. Being diversified across countries and sectors is really important, and that will help smooth out the ups and downs of that journey over those few years. And a good example, we've got a high growth fund that is highly diversified across global and domestic share markets, all index based. That's actually, despite some of the turmoil that's been going on in the world and markets as well that have been going on, it's still positive and up, and people have actually had a really consistent journey with that. And I think it shows the importance of having a good, simple, diversified strategy. But even the same thing when it comes to index funds. We've got thematic index funds. These are quite specific themes that are more susceptible to short-term volatility, and just going it all in on a thematic fund is equally not a good strategy. They are diversified in the sense that it's not just a single company, but you are in a quite particular concentrated sector or theme. And so again, it's a diversification isn't about the number of funds or necessarily a number of companies either. It's about being across sectors and countries.
Yeah. Okay. Nice. On the KiwiSaver front, you talked a little bit about, approaching KiwiSaver as a soon concept if it's, 5 kind of years away, but also acknowledging that it probably has a much longer time horizon than just the 5 years, because you're not going to spend all of your money in KiwiSaver on the day you retire. In terms of, I guess, then thinking about how someone would start to potentially reduce their risk over time, is there a general rule of thumb? I know that's very broad.
So you can, if you think, let's take KiwiSaver as a real specific example and take from the lens of retirement and getting close to retirement. So as mentioned, as you get close to retirement, you'll have an intention to start accessing and using some of that money. You've got $100,000 in KiwiSaver. You want to start to get a little bit of that every year to top up the NZ Super or other income sources that you have. Now, this piece that you need to get the cash from, obviously, you almost want to bucket that asset and say, right, we need some that's in kind of more cash or defensive type investments, because that's the stuff that we're going to start accessing today or really soon. But the stuff that's going to be put aside for, actually, we need it to be generating a return and growing still, because we want to start tapping into it 10, 20 years into our retirement. You can be still in high growth. And I think the mental accounting and bucketing of those investments is quite useful. And so what you can even do with Kernel, for example, is you can actually split your KiwiSaver into those buckets. So say you had $100,000 for round numbers, you could go and put 70,000 into a high growth and 30,000 into a cash fund. And what you're doing there is almost that mental piece of going, right, the cash element of that is what we're going to start accessing and selling down to top up our income, while the growth piece is the stuff that we want to keep working for the longer term. And we don't really want to start tapping into that for 10, 20 years into retirement. So, we know people like that quite simple bucketing and mindset, and it's kind of the whole now, soon, later concept. But with KiwiSaver and some providers, not all, you can do that. And Kernel gives you that flexibility to bucket up based on when you're starting to want to access it.
It is interesting you say that, because I think for a lot of people, the kind of traditional thought has been, well, I will maybe, just live off the income of my investments, whether that be an investment property or perhaps it's my KiwiSaver, and I'm just going to draw down on, essentially the yield or whatever dividends are paid. But as we have seen, markets change and the variation of, I guess, industries and sectors succeed over the last 10 years, that's been challenged a little bit. And so this kind of bucketing approach you're suggesting, probably counterintuitive to that way of thinking, because you need to be okay to draw down from certain parts of your portfolio at certain times.
I think New Zealand is a little bit interesting when it comes to investing in shares and equities particularly. There is this obsession with dividends and this mindset of dividends as being the way to get an income, a passive income. Dividends are not actually how you should think about getting your income source. Chasing high yield and high dividend stuff may actually be a detriment to your total return on your wealth over time. And so, from two fronts. One, if you're buying a bunch of shares to get dividends from them, if you want to reinvest those, you'll be probably paying extra brokerage, you've got the tax to consider. So you don't actually in New Zealand have any real risk, because PI funds have no capital gains tax. So you can be invested, have everything reinvesting, and then just take out income. So you could effectively go, right, I want to sell $100 a week of the cash fund, and that's your income, and you don't need to think about the dividend element. So we're doing an article on this at the moment. So at some point probably in the new year, we'll have a nice piece talking about dividends and income and how to get that passive income stream.
Love that. Great. So a couple of other questions people submitted around, I think, things that we would classify under a soon goal. Buying a house. The idea of, I guess, this is still a very primary goal for a lot of Kiwis, and that's a great thing to achieve. But that pressure, or resisting that pressure of how soon you should do that, and whether that's really the first financial goal that you should be working towards in order to kind of get that step up or leapfrog towards financial freedom. What's your view on that?
I think it's the main message really is don't feel pressured to buy a home. We've done some articles and papers on this previously that show that actually you can build wealth in New Zealand now through investing in KiwiSaver that will give you the same outcome in retirement as owning a home. So you have a lot of flexibility today through the ability to invest well and have good KiwiSaver, to have financial security without it being reliant on property as the only solution. Obviously, we all will aspire to have a home, but you can have flexibility about when that fits in with your lifestyle situation and your income situation, because equally, a bit like taking the holiday situation, feeling pressured to buy a home, which, by the way, the average first home age now is like mid-30s,
late 30s.
Late 30s. It's not everybody buying a home at 21, like stuff another media may make you think. The fact is that you should think about what is the consequence to your day-to-day life as well of buying a home. Many people have probably bought in the last couple of years and now feeling the pain that comes from having higher interest rates, and that's going to impact the lifestyle they live, the things that they can provide for their family in terms of experiences and travel and other goals. And so a home is a really important asset, but equally you can get a really good situation through renting while you figure out and build up the other assets that you need and work out when it's right for you and your family. That is why it's a soon goal for many years. There's a flexibility there, and being patient, I think, is a really key piece.
Cool. Really good question here, because we were at an event yesterday where they talked a lot about cash fixed income. Obviously, with where interest rates are at the moment, that's kind of a hot topic of conversation. And someone had asked, if I'm thinking about a soon goal or something that's sort of midterm onwards, why would I even consider investing in shares right now when I can just get a really good rate of return on a term deposit or a cash fund or a cash account?
And that's the thing, like a lot of people look at that and go, great, I can get a cash fund that pays 6% and effectively no risk, right? In people's mind, is that like you've got confidence about that is going to be a stable investment. Whereas share markets have been relatively volatile, have been up and down.
Yep.
The reality is that when you account for tax and inflation, that money for those soon goals is actually still going backwards in real terms when you factor in the inflation and so the erosion of purchasing power and the tax on it. And it is an important reminder that while there's been a lot of volatility in the markets and global share markets, as particular stocks, have been down a lot, I think our global 100, for example, is still up about 15%. And so being invested in shares for those longer term and medium term goals is still really important. It is the only way to really kind of combat inflation over time.
And I think as well, given the current situation of interest rates and the fact that we have come off the back of 40 years of declining interest rates before the last kind of 18 months, 2 years, no one really knows what the new normal of interest rates are going to look like. And so we're, big fans of diversification and focusing on the long term. So we don't want to write off one whole asset class right now just because, cash is paying a really good rate of return.
Exactly.
Yeah. Awesome. So I guess some kind of key takeaways on the soon areas is, we're talking about those medium-term goals. We want to be looking at something that's a little bit more risk skewed in terms of your asset allocation to make sure that you're getting a higher rate of return for something that is, beyond 3-5 years away. There is an element of flexibility there, and it is making sure that you're considering your risk tolerance and that goal with the asset mix, thinking about things like shares in addition to kind of cash and bond funds as well. Excellent. Great. So later, this is kind of the fun stuff, depending on how much you like to plan. But for anyone, I think, a later goal is really anything that's, 7, 10, beyond 5 years away, right? It's kind of the stuff that we know we want to do in the future, but we really do not have a defined time frame. I would even categorize retirement into this because although we can access our KiwiSaver at 65, for a lot of people, they have a different idea of what retirement looks like. My parents, my in-laws, they're all working well beyond their 65th birthday at the moment anyway. And so, as Dean mentioned at the start, even if a retirement goal is on the horizon for you, you don't retire and then use all of your money and that's it, done deal.
I think with the later stuff, it's more general concepts of what you're trying to achieve, but less detail. Obviously, as with any goal, the further it out it is, it's more aspirational, kind of bigger planning, but doesn't have all the detail exactly what it looks like. But obviously, with that time, you now have a lot more flexibility with the types of investments and things that you can consider. Later is much easier to plan for from an investment point of view.
Exactly. So on that, how exciting would we get? Are we talking about, all sorts of investments? How do we kind of narrow down the universe?
It means that you don't have to be weighing up how much should be, there's less weight that needs to be considered around how much should be in sort of more defensive, conservative investments versus growth type investments like shares. Because with later, you can focus much more on just getting things into higher growth, working for you investments, and you're not as sensitive to the balances because you're going to ride the ups and downs. You've got time on your side. You've got patience there.
Yeah. Excellent. So for those of us, because we sort of put a pin in this on the KiwiSaver front, that considering KiwiSaver as a much later goal, it's something that, let's say we're post first home purchase and we're now, full working careers and going to be accessing that money at a minimum of sort of 30 years away. How much risk should we be thinking about? How much kind of growth allocation?
If you've bought your first home or you're not planning on accessing a KiwiSaver for 10, 20, 30 years, you probably want it working for you. So that means looking more towards a growth or even a high growth option. So by that, a growth or high growth, that means the largest proportion of that is into shares, which is the asset class over time that has delivered the best long-term returns. And so a growth fund typically may still have about 20% in fixed income and bonds, whereas a high growth, or otherwise also referred to as aggressive, will typically be 95 to 100%. And so, if you've got that time, you really want to look towards more that high growth kind of optionality.
Yeah. Whilst on the topic of KiwiSaver, I can see Alex here had a question about the Kernel KiwiSaver specifically and sort of what funds rather are available. So, Dean, what can you do in the Kernel KiwiSaver?
So with Kernel's KiwiSaver, it's almost a mirror image of what you can do for general investing. Same fee, same fund. So there is currently 19 investment options available to you. They include diversified, so cash, balance, and high growth. And then you also have all of the individual funds where you could fully customize how you see fit and relevant for you and your life goals and your values. KiwiSaver. So you may really value climate and ESG factors, so you could build an entirely ESG portfolio through Kernel, or you can have the simple set and forget. So same fees, same platform, same login, fully flexible to you.
Yeah, awesome. So a couple of questions in this category. Kind of the age-old one of KiwiSaver balances being down. There has been a reasonable amount of volatility in the markets, as you mentioned, given geopolitical things going on right now. Should people be worried?
No, look, again, KiwiSaver is almost the forcing you to have the habits that we should all have in our day-to-day investing life, which is continual investment and long-term, not changing it all the time. So these are habits that you should take actually to your general investing approach. With regards to what to do with your KiwiSaver, there are two pieces to that equation. One is, are you in the right type of fund for the stage? So, as we've discussed, obviously, the sooner you want to access that for the now, you want to be looking more cash type investment profiles. But if you've got time on your side, you want to be looking at the higher growth type options. So that's getting that right. And then the second is, are you in the right provider or KiwiSaver scheme for you? Many Kiwis have been with the banks predominantly because they effectively were the ones that were involved from day one of when KiwiSaver came to market and people were put into KiwiSaver. But there are a lot of people who have never actually engaged or looked to see where their KiwiSaver is, and many don't even know who their provider is. So you can look to change providers for a number of reasons. One, lower fees, better investment options that align to your needs, or even just you like the value proposition and the service that company provides. And so, I think Kernel does an incredible job of that. We've got thousands of Kiwis now that are leveraging our KiwiSaver. You can switch between providers even if your balance or returns are showing as negative. That's the other big message here. A lot of people go, I don't want to switch my high growth investment to another high growth investment because am I locking in the losses? If you're going from one to another and they're the same type of profile, then that's all fine. Like, it doesn't matter. You're effectively going to sell a bunch of shares over here and buy a bunch of shares on the other side. But hopefully you'll be in a better outcome from a lower fees or better alignment with what you need. So you can switch at any point. Switching KiwiSaver in New Zealand is actually really simple. Once you create an account with the provider you want to go to, you simply click a couple of buttons. Well, I actually don't know about everybody. I know this is easy as it is with Kernel. With a couple of buttons, you can switch your KiwiSaver, and then behind the scenes, it's all taken care of in terms of transferring via the IRD from your old provider.
That's a really good point. One question I was going to ask, because I know this was submitted, is, often when we decide to make a switch either between KiwiSaver providers or investment providers, if we're also investing, it's really natural to feel a bit nervous about the fact of whether or not we've made the right choice after doing that. And I think particularly with KiwiSaver, because there is that sort of downtime while the providers are doing all of the legwork in the background.
Take up 10 days,
exactly. It can take a few days. And then, of course, it's a long-term investment. So you're not necessarily going to see a change in return profile or experience for a few months. So how would you encourage people to kind of sit on their hands and be patient, or ensure that they've made the right choice and not sort of second guess themselves?
Yeah, I think this is part of any good investment process, right? Taking the time up front and building comfort of where you're investing and who you're investing through as to why you want to be with that platform or provider. It's the chance to understand, what is this all going to cost me? What are the options? Is it going to suit my needs? And when you've got that confidence, you can implement it. And with any good investing, then it's about actually sitting and forgetting it. The whole point of what we did with Kernel was to really try and make that automated set and forget. And you just focus on the long term and living your day-to-day life, and check back in down the line.
Yeah. Awesome. Cool. So a great one that's also come into the later category of questions from the audience is the age-old debate of property versus shares. So we've touched on, obviously, debt, paying off debt versus not. But let's just say, we are in a situation where we either have some surplus, cash flow to start working towards something, or we have a lump sum of money and we're thinking about, should we invest that in the share markets? Should we go down the investment property route? What are your thoughts on that?
Look, I think we're setting up for probably what's going to have to be a great property versus shares debate at some point.
Yes.
We've written a lot about this. We talk about it a lot. And obviously, it's quite simple from a couple of lenses. One is that the best performing asset class over the long term has been shares, followed by property, then bonds, then cash, right? That's kind of the asset class level. Property has a number of challenges with it as an investment. One of them is it requires a lot of upfront capital. You need to have a relatively large amount of equity or cash to be able to buy, particularly an investment property. Many investment properties in the market today are cash flow negative. That means that you're going to have to probably top that up. So not only is there an investment, but it's going to cost you day to day from a cash flow point of view. So that can be challenging for people, and it can create risks, because obviously if all of a sudden interest rates have gone up and you can't get the rent to go up, then you start to get quite squeezed from a cash flow and servicing point of view. The big benefit of property fundamentally, though, has been the leverage. That is what makes property investment so attractive to people, is that you can go and borrow 60, 80% from the bank to buy that property, but you'll get the upside, assuming that there is capital gains over time, right? So I think that, as with all of these things, there's no one or the other. It's about what's relevant and useful for you. What do you want to be doing? I've had investment properties. I must say, not having investment property is really nice. It's incredibly painful to deal with, and the maintenance and all the challenges that come with it. And as you touched on, the context of property, particularly in New Zealand, we're obsessed with property, is that there's been 40 years of declining interest rates that have fueled the valuation growth in property. It is still a relatively risky investment for all of your wealth, in the sense of we are a little island at the bottom of the world that is highly susceptible to natural events and disasters. So if you just own investment properties in Napier or Christchurch, people have seen how exposed they are to uncertainties and major catastrophic events. So again, having investments and being highly diversified, like in an index fund, you are effectively more investing in the long-term business growth of the global economy, rather than just being exposed to a house on the neighboring street.
Love that. I think that ties really nicely into kind of, I guess, the kind of key takeaways thinking about later goals is, there's no one size fits all approach. It is a case of thinking about, well, what am I aspirationally working towards in the future, and how much risk am I willing to take on, and how much risk do I need to take on to actually kind of have a best chance of getting there, because often being too conservative too early in our lives can be a detriment. And then, focusing on diversification, because as you so rightly pointed out, it can be very challenging from a capital point of view to have adequate diversification across investment properties if that's all we're doing. You know, most of us could perhaps stretch to buying one investment property, and that's one house in one street in one suburb, rather than, you know, the very easy ability to be diversified from $1 in the share markets and really be spreading your risk that way. Cool. So that kind of wraps up the more like formal portion of today. And we just want to then, I guess, dive into all the questions that have been submitted. We do have some here that I'll run through now, but please, for anyone that is online, feel free to submit questions and I can see them and we'll talk through them. But a good one that I loved, because it tied in, Dean, to the comment you made around the average first home ownership age of New Zealanders is 38. And someone here has said that they're in their 40s and they are in the bucket of wanting to save for a first home, but also wanting to maintain a lifestyle where they can travel and do other things. How do you work towards multiple goals at the same time?
Oh, good question. Look, obviously the key there is trying to make sure that you have got the discipline and habits in place. That is all it really comes down to, is living the life today is really important. And so carving out and allocating cash flow towards that is the first step. And then making sure you're disciplined with putting aside the rest of that cash flow towards building up the longer term asset base. So it's really setting up those habits and then getting that money allocated in the right way to both deliver what you need on today, but make sure that you're also building up to achieve those longer term goals.
I think on that, you know, using automation on your side as well, there's a lot to be said for just automating things so that whilst you're working towards things that are a bit more short-term instant gratification, you have that comfort that something is also working towards your kind of longer term goals as well. Oh, a few questions on tax. We may put a pin in tax and come back to that. But actually one that is kind of topical.
Tax is really important at the moment.
I know. And one that is topical because it was in the media just yesterday is some talk from the IRD around taxes on capital gains and taxes paid by kind of shareholders or share traders as opposed to those that are investing in long-term funds. Could you give us the high level of the difference on that?
You've given me a window to talk about tax, which is my favorite topic. So I'm going to go big and broad on this. Happy lunchtime, everybody.
Yeah.
There are a couple of big things with tax. People forget in New Zealand that trading of shares is potentially liable for capital gains tax. So there is no carve out that says there is no capital gains on share trading in New Zealand. So people have to be really cautious of this. The reason why it's come up is that there was an article in Business Desk yesterday talking about that the work plan from IRD has been looking into and will be looking into share-based trading platforms and potentially those customers' liability for capital gains tax. PI funds and diversified PI funds, the equivalent of your KiwiSaver and general investment funds like Kernels, are not liable for capital gains tax. So that's a big piece there, is that if you are trading shares, you do need to be really cautious that actually you may be paying quite a large capital gains tax on any returns that you generate on that. And as with everything related to tax and IRD, no, you would not get a refund if you'd made a loss. So it's a one-way street with tax.
Yes.
So that is something to be cautious of. The nice thing about diversified funds, and as it comes back to even getting the cash flow piece I talked about, being in a PI fund and you don't have capital gains, so you can, unlike say in the US market, you don't need to chase dividends. You can just say, actually, I want to sell $100 a week and there is no tax consequences of that. So PI funds are really good from a tax point of view all around.
Mm-hmm.
The other big one that why people are increasingly looking towards PI funds is because the tax paid on a PI fund, like Kernel's investment funds and KiwiSaver, is capped at 28%, mm-hmm. whereas personal tax rates up to 33%, and now, of course, up to 39% as well. So yeah. That's quite a savings in terms of if you were buying direct shares or foreign shares, you would be paying tax on that personal tax rate rather than the capped PI tax rate.
Yeah.
And one of the things why this is really important is people are looking to reset for the new financial year, their investments. And there has been talk, and everybody's waiting to see whether the coalition follows through with, for some followers, I'm sure, is the proposal to increase the trustee beneficiary tax rate to also be 39%. Yeah. So if you've got a family trust or you're involved in that space, then obviously PI funds are again another tool that people are really looking at.
Yeah, awesome. We've got a question here from Seth, which I really want to dig into because we've sort of talked about this, but I know it's something that people find really challenging, and it's the whole idea that if you're approaching a later goal, how do you actually start to reduce your risk allocation over time? So how do you say move from a high growth portfolio to a more sort of, let's say, balanced portfolio over time? Yeah. And I will hand this to Dean, but before I do, I just wanted to say that from my financial planning background, the number one thing to remember here is you need to remove yourself and the emotion when you're doing this type of, asset allocation change, and try and make it as structured as possible. So to the point around using automation, what we would often recommend or suggest people do is start to make asset allocation changes in a structural way, let's say every 6 months or every quarter, or it's, so it's totally irrelevant as to what's happening in the market at that point in time, because the factor that's driving you to make that change is the fact that your goal is approaching, right? So it's trying to remove the emotion, because you otherwise get into the inadvertent trap of timing the market or worrying about what the markets are doing. Yep. Anything to add?
No, that's what I was going to say. Covered.
Yeah, there's no kind of rhyme or reason as to how and when you should start doing it. It does depend on when your goal is approaching. But I would say, have a plan, stick to the plan, and try and make it as methodical as possible.
Yep.
Cool. Another great question from Alex. So if you're splitting KiwiSaver into multiple different funds, how can you ensure you're not overexposed to any one company or sector? And this is a great question, because often people think that to be diversified means they need 7 to 8 funds, and then potentially end up with lots of crossover. So how could we look for that?
Yeah, obviously, one option is just to take a diversified fund and set and forget, because it's all done for you. If you're picking individual funds, at least with Kernel, we've tried to make sure there's not too much overlap. So if you're doubling up on kind of similar funds, like a Global 100 and Global SG, you'll probably have a little bit of overlap. But outside of that, they should all be able to be complementary to each other. We did have an Insights tab as well. Like, you can see all the holdings on Kernel's marketing page and our website, and then you can also see within the dashboard all the individual holdings and calculate and see actually at a portfolio level how exposed you are to any individual company and sector.
Yeah. And I think, our customer success team is always happy to help in that space, because we do know the general sort of crossover. If there were particular funds that you were looking at and you were concerned about and you wanted to see, well, what's the correlation or crossover between those certain funds, we can absolutely give you a bit of a general insight into that. And we focus predominantly on making sure that sectors are well balanced, because you can get a little bit tied up in the nuances of individual companies, but making sure that you have good sector diversification is important. Great. Okay, lots of questions on property because we're in New Zealand, so of course there are going to be. So question kind of for those at the start of the journey, for the first home buyers with high interest rates, general thoughts around getting on the property market, paying off really high mortgages versus just renting. This probably ties in a little bit to the numbers that we did for that case study that Stuff picked up. Thoughts on that?
Yes, so we have a case study. Do feel free to reach out to us, and we can share it around, and we'll publish it again at some point. But again, just come back. It's quite simple. Don't feel pressured to buy. There's a lot that's happening in this market. The change in interest rates has been really dramatic. It's one of the fastest rises. We basically went from 0 to 5.5% OCR overnight, and that's a big impact in terms of property values, cash flows. So there's still a bit more pain to potentially come in this space. Things are starting to stabilize now in terms of the rate rises. So now sort of picked to be relatively flat and potentially declining late next year. Marginally, not significant cuts probably, but it will give people a bit of time now to kind of reassess and see where things start to settle to. And then you'll be able to understand and have a bit more certainty about your planning in terms of the cash flow, what the serviceability is going to look like, how big that debt is. But
okay, cool. There's a question here submitted around if we as Kernel have some thoughts about funds that provide monthly income. So they've given us a couple of codes here. So they're ETFs. And I'm guessing the question is kind of in line with you're wanting a regular income.
This is coming to this focus on dividends. And I've kind of point to the fact that in other markets, the capital gain structuring or other tax situations may incentivize people looking for dividends or regular paying. In New Zealand, with pie structured funds, you don't have any of those tax considerations. So you don't actually need to have a fund that has a particular payout or distribution frequency or buying a bunch of shares to try and get regular dividends. You simply can be invested in a well-diversified pie fund. You can even have that fund reinvesting its own distributions and then say, actually, we want an income of $100 a week or $500 a month, and simply sell some of that investment every single month. That's actually a much better way to structure it in New Zealand. I think people are really focused on the dividends and income paying funds because in the US, that's more designed for their tax situation versus what's actually relevant for a New Zealand investor.
Cool. So portfolio specific kind of questions. This is a great one because we get this a lot, and it does certainly apply to everyone regardless of what kind of goal you're working towards. But how often should I check in on my strategy and potentially change my plan?
Look, if you set up right, even for this now kind of money, you shouldn't need to log in, once or twice a year is actually probably all it would take. Of course, we know that's not how we operate. We live in a 24/7 world, and we like to log in and see our portfolio. If you like to log in every day, that's perfectly fine. Key is just don't push any buttons every day when you go in there. It's the set and forget. The whole point of good investing habits and for everybody at all stages is not tinkering and trying to time the market or keep switching and changing. You'll have a bigger impact and typically negative impact on your overall wealth from doing that than just leaving things.
Yeah, exactly. This is a big one, so we'll try and answer it in a couple of minutes. But thinking about, I guess, higher growth allocations, some of those longer term goals, and weighing up the options between individual shares, exchange traded funds or ETFs, or say managed funds like a Kernel fund. How would we start to conceptualize narrowing down that universe to say one of those options?
Look, for most people, right, the key to good successful investing is getting the right type of assets for your goal in place first. So if it's a long-term goal, you want to be more towards shares or growth assets. And so if you take that lens, okay, we're investing for the long term, we're not going to touch this money for 10 odd years, then being diversified across country sectors, keeping costs low, getting tax right, they're all the things to think about first. So If you're a high income individual, then you want to look at PI funds probably over direct shares because of the tax as well. You need to factor in all of those pieces to the equation. And then it's like, well, actually, for the majority of people, the habits and getting all of those pieces right is what's going to drive most of the long-term return. So index funds are really suitable for this because they tick all of those boxes. Whereas if you're just trying to pick individual shares, like you potentially got negative tax consequences to think about, you'll have higher sort of transactional costs, and it's going to take a lot of work to maintain trying to pick each of those and then hopefully outperforming the market. And it's incredibly hard to outperform the market. I think in New Zealand over the last 20 years, 75% of stocks actually perform below average. So even picking a stock is not a 50-50 chance of doing better than the market. And we see that over and over again. It doesn't mean that don't invest in direct shares. It's that for people that want to build and have a good probability about their long-term goals, well-diversified index funds are key kind of core building blocks for that. And then you may have some money in direct shares, but it's not the dominant amount of your wealth. Yeah.
Cool. Good follow-on question from that. Considering a New Zealand-based fund or investment versus say one that's listed on the US stock exchange, there's obviously a lot of people will be familiar with the S&P 500 and consider options like Kernel's fund or another fund based in New Zealand versus just buying that ETF listed on the US exchange. The question is around, they seem to have different returns, but then I have to also weigh that off against how much it costs to say buy in USD and factoring in exchange rates. So as a mere mortal, how do I do that? Because that seems like quite a challenge.
It's really hard. And so take the S&P 500. Kernel's got an NZD hedged S&P 500. So that means it's effectively trying to remove the currency changes. But depending on the platform and products you're looking at, it can be confusing and may take a little bit of time to make sure you're looking at apples for apples. Because, for example, if you buy a US share and that share is $1, let's say, if that goes up to $1.50 over time, but the exchange rate between New Zealand and US dollars has fallen and offset those returns, you may still see no return from a New Zealand perspective, but the US investor could see a 50% return. So you need to consider the fact of, are you seeing this on an apples for apples basis, so both returns in the same currency for that respective investor. So if you're looking at the S&P 500, you need to make sure that's adjusted back to New Zealand dollars, because ultimately you're going to be buying or selling and bringing that back to New Zealand. So you've got to do that first and then make sure that you're looking at the other pieces. So don't just jump to a simple conclusion of taking the high return product, because you've got to make sure that you're looking at them in the same currency. Some platforms, I'm not sure how they present it, but I think you may see US dollar versions, but not necessarily a New Zealand dollar version either, and how they show the returns can make it even more confusing for investors.
Yeah, cool. Question here from Vitesh, which is awesome because this was also submitted, is basically around how much exposure should I have to the New Zealand share market? Because, New Zealand, I think we did, yes.
Yeah. So New Zealand is relatively small in the context of the global financial markets, which is why people go, look, we're less than 1% of the financial markets. Why would I have more than 1% in New Zealand share market then? It's called home bias, and every investor in every country around the world typically overweights their home country in respect of its current weight. So if you're in Australia, Australians also have much higher weighting to the Australian share market than the Australian share market is represented in the global financial system. Now, often the main reason for that is tax. So as a New Zealand investor, you get the benefits of imputation credits and the local tax versus, say, investing overseas. And most markets are designed to kind of drive people to invest locally in their own country. And so I think it's around 1.8% kind of hurdle that foreign shares need to deliver to get the same kind of extra outcome as a New Zealand share. So there are tax benefits and incentives for being invested locally, which is why pretty much every KiwiSaver that you look at, most investment portfolios will have a higher weighting towards New Zealand. Now, New Zealand's relatively small. We don't have some big sectors that we've talked about. We don't have the big technology sector here, but we do have some great utilities and other sectors. So having that international investment will also make sure that you've got some exposure to sectors that may not be available from New Zealand only.
Yeah, cool. Back to retirement, because this is a really common not misconception, but I guess way of thinking, and also a genuine concern that I see people have. So, someone approaching retirement, thinking about, well, when I hit 65, I've worked so hard for so long to get this money that I need to then live off. Should I just put it all into kind of term deposits or a cash fund?
Yeah, and that's the key. It's like we want comfort and confidence in where we place our investments and where our money is sitting. And often that can mean I will just put it into a term deposit. But if you work really hard for that money, the trouble is that many of us will live 20, 30 years in retirement. A large portion of Kiwis are now living well into their 90s, and they're living actively in retirement. They're wanting to enjoy, they're out there, they're spending time with grandkids, they're traveling. We are fit, healthy, living longer. And by putting it just into a term deposit, while it feels safe, the big risk is that you will run out of money over time as you start to draw into that, because it's not generating enough returns to fund down the line. And that's where I talked about the bucket piece. You can still be well diversified and have confidence in where you're placing investments, and know that over time, even being invested in shares, you'll ride through the ups and downs. So it's just that long-term mindset and understanding that actually you still need money working for you if you're going to want to enjoy and maximize your retirement.
Cool. We've got a question here that's around, when is it even worth starting investing? Because with the current cost of living and interest rates being higher, people have, larger mortgage payments, more bills coming in. We had a customer write in and say that, they can kind of commit at the moment to only investing $20 a week. And it feels a little bit like, why should I even bother? Should I just put that money towards a savings account instead? What are your thoughts?
$20 a week and 10 or 20 years from now is going to be a large amount of money. But the biggest piece from why starting, even if it's a small amount, and you're right, like $20 isn't going to fundamentally change the world in the short term, but what it does is it creates habits. And that's the most powerful factor, is creating the habits and discipline of regular investing is really key. And so starting small is perfectly fine, and it's actually a good thing to do and build into it over time. And I often refer to it as like the gym. It's like just start small and get into the habit of going and keeping up your fitness, then you'll see the rewards of that over time. So you don't need to feel pressure to think like day one you need to be a bodybuilder. It's start small with the gym and go regularly, and you'll get those long-term benefits from doing that and having habits and discipline.
Yeah, cool. David's asked a question back to you, Dean, which I really like. So he's commented that having, say, more than 10% in New Zealand shares feels risky to him. And I'd just be interested to understand your view.
Yeah, look, I think, I guess it's curious as what the risk is. New Zealand is a strong, developed economy that is, got a strong, stable government. We are a safe country overall. We have a lot of prosperity and opportunity as a nation in terms of the things that we export, the goods we make, the services we provide. And so you look at that lens, it's like you're diversified across a number of companies and sectors here. These are often really large companies who are well-proven entities as well. We're not a share market full of or dominated by sort of more speculative entities either. So I think there is a lot to be said for the quality of in New Zealand, larger companies that we have available here, and the strength of our overall economy. Even, take the view of our debt. Our debt to GDP ratio is one of the lowest in the OECD. If you want to look at risk, you could look at the US situation and go, well, actually, what is their future going to look like in terms of the servicing of that debt for that country? And you've seen those structural changes that can come from that of a sort of 50-year lens, obviously. So I think when you look at all the factors of New Zealand as a whole, we're a really attractive market to be invested in. And to me, I think there's a lot to be said for it.
And I think as well, David, on the comment of like home bias, it's not uncommon if you approach a US investor that their home bias sits closer to like 80%, right, in the US markets. So in the context of us considering, well, should we invest 10% in our own home country? It's actually very, very low proportionally to how other people typically approach their home bias. Cool. We're not going to go back to tax, so I'm just going to skip past that section. We've got a couple more minutes, so if anyone online has a last-minute question, please do chuck them in now and we will get to them. But in terms of, I guess, building those general habits that you talked about, Dean, are we better to be putting away money either into savings or investing every single pay cycle, or should we be kind of squirreling it away and then investing it in larger chunks ad hoc?
So good question. Basically, we're not trying to time the market. So if you're looking to invest and you're looking to invest long-term into index funds, say, then you want to have that money invested as soon as possible. So payday is the best day to get it in there, not putting it aside and then doing it later. So time in the market will give the best long-term outcome for investors. So the sooner you get invested, the better.
Yeah, awesome. Great. Well, I don't want to keep everyone because it is a beautiful day here in Auckland. So hopefully you can go and enjoy the rest of your afternoon. I will just say Veronica's asked a question around, Kat and Christine, when are you doing another podcast? And you'll be pleased to know that we are actually recording a 6-week season that will be coming out in the next couple of weeks, kind of tailored around things to think about over like summer and the new year, specifically in kind of shorter bite-sized episodes. So stay tuned for that in the next week or so. And one last question from Susie. Oh, specifically on the Global 100. No tax, thank goodness. The Global 100 and the Global ESG, is this the same kind of profile? And I'm going to assume you mean in terms of general risk allocation. So
similar in terms of risk. You can see the risk indicators on them and you can see sort of relatively comparable there. Global 100 is sort of the large global companies, the big names, that actually, by the way, make up a really large percent of the global share market anyway. These are big companies. Yeah. So it gives you exposure to what most of the developed global share market will look like anyway. The global SGs are highly diversified, spread across 24 developed markets, I think it is. Yeah. And so probably more spread and diversified. So it's up to people as to whether they want the large names or whether they want to be more spread across different countries, or whether they also, of course, want the more ESG or climate integrations to their portfolio. Yeah. But do feel free to reach out with any questions. And I think in a good reminder that if you are not yet on our newsletter list, do sign up to that, because that's where you'll get all of the latest insights by being involved in that. And obviously there's a lot of big things that's going to come from Kernel over the coming months. So you do want to make sure that you're across all of those as soon as they are announced. Yeah. And of course, encourage everybody to have a look on the platform, sign up if you haven't, and obviously have a look at the KiwiSaver and come through with any questions that you have to ourselves and the team here. We're always available to support.
Yeah. For those of you that submitted rather specific questions, our customer success team is going to be aiming to get back to lots of those tomorrow. So if there's anything burning that you haven't had answered today, please do reach out and the team will be in touch.
Thanks.
Great. Have a great day.